Alright, on to the next video in our series. Now that we've covered naked puts, selling a naked put, selling a naked call, we covered doing both at the same time, which is doing a strangle. Then we covered buying a call and buying a put. So now I want to go over back to selling premium, which is selling naked puts or selling puts and calls. But this time I wanted to do it as a defined risk trade, which means your risk is the amount of money you can lose max is set or defined. All right. So let's go to you hit your trade icon here, and then we'll pick. We'll just do the SPX again because that's the generic or the broad base index here, and your trade screen will pop up. Okay. So what we're going to do now is we're going to combine selling a call and buying a call with selling a put and buying a put. So as you recall, selling a call and selling a put is basically a strangle. Okay, so let me show you real quick what that looks like. Click on strategies, you can click on strangle. Mine is set to default short strangle. Again, short means you're basically selling a strangle. The star means it's default. I expand my thing, it's 56 days is my default. One standard deviation is also my default, and you click go. Okay, so real quick review. So again, selling a strangle means you're selling one put, one standard deviation out of the money. You're also selling a call, one standard deviation out of money. Those are these blue lines. So you make money as long as the SPX, SP 500 stays in this green area. The green area is where you make money. So you don't care if it goes up, you just don't want it to go too far up. You don't care if it goes down, you just don't want it to go too far down. And you don't care if it stays the same, no matter what, you'll make money. How much money will you make? In this case, you'll make $14.48 per contract. Each one contract is 100 shares, so times this by 100, so you'll make $1,448. Okay, if the SPX stays within this range, and it is in this range at the end of your expiration period, which is at the end of October, 60 days from now. Okay, so this is basically selling a strangle. Now, if you click on here, it'll give you your probability of profit and all these numbers. So your max profit you can make is $1,448. But if you see here, your max loss is practically unlimited, because technically it could go to zero, and technically it could go to zero, and also technically it could go to infinity. Okay, so if it blows past either one of these put or call strikes, you know you're gonna lose money. The more it shoots past, the more money you're gonna lose. Okay, and I'm talking about at the end of the 60-day period. You will also see that this also ties up capital. So how much capital does it tie up? Let's see. It'll tie up approximately, will it say here? It's not showing my maximum, or what I mean, it takes up buying power, so it doesn't show me that, but that's okay. Let's go back to this. So what I want to do is I want to show you how you can limit that loss. Okay, so to limit that loss, this is called selling a vertical spread. What I mean by that is, and basically this is what a golden gecko is. It's a vertical spread on the put side and a vertical spread on the call side. Okay, so let me just clear this and let me show you what I mean. So go to choose strategy and go to iron condor. Alright, and over here my default is set for normal iron condor. The star means that's my default setting if I want to sell an iron condor. Advanced settings are the same, 56 days expiration, monthly, one standard deviation away. Okay, and click go. Right, so this is an iron condor. So if you look, you're still selling the put at 1895, and you're still selling the call at 2120. Look where your green area is. Your green area is still in between these two strikes. Okay, your red area is still, if it shoots below 1,895, or if it shoots above 2120, this is where you're going to lose money. Again, as long as the SPX in this case stays within this green area at the end of 60 days or whatever your expiration you set for, you make money. How much money do you make? Well, remember the last time was like 14 bucks and change, 14.41. Now you're only going to make 80 cents. You're only collecting 80 cents, okay, for this trade. Okay, or the most you can make is $80. Well, why the big difference? The big difference is you have capped your profit and capped your risk. See, by buying the 118.90 put and buying the 21.25 call, you limit your losses if the SPX shoots above these numbers. Why? Because remember now, if you buy a put, if you buy this put right here for $12.35, you're betting that the the SPX will be below 1,890 at the end of 60 days. Okay, by buying a call here, you're betting that the S&P 500 would be above 21.25 at the end of 60 days. So what you're doing is you're kind of covering your butt here, because what if this shoots up past here, right? This position will lose, but this position wins. Okay? The problem is, well, let me show you the difference here. If you click on here again, it'll show you what the max you can lose. See, now look. The max loss before was unlimited. Okay? Now your max loss is capped at $420. Okay, why? Because you only can lose on one side. If this shoots down all the way past here, you'll lose money on this position, but you're going to be making money here. You're also going to be lose money on this position, right? Because this bet is a bet that'll be higher than this. Okay, but you're going to be making money here because this is a bet that it'll be below 21.20. So it shoots. If it shoots up down here, you're making money here, but you're losing money here. So that's basically that spread is why you're capping your losses. Okay, so a lot of people like this because you can define. Okay, I only want to risk a certain amount of money. So this is a great this is a great trade or a great thing for me. Now, don't get me wrong. The reason why this can get so expensive is because the XPS is a pretty expensive stock to trade. It's trading right now at $2,000 a share. Okay, so the miniature version is called the SPY. Okay, the SPY, as you can see, is 1/10 of it, so it's $200 a share. Okay, now watch when I place the same Iron Condor on a smaller price index. Go to Iron Condor, see all this stays the same. Click go. Okay, and I'll zoom in. Okay, one more time. Alright, so as you can see here, same thing. As long as the SPY, which is the SP 500, stays within these two strike prices, $191 on the put side, so I'm betting the S&P 500 would stay above here, and I'm also betting that it'll stay below 210, the call strike, right? So this is my strangle portion of the Iron Condor. The green area is again where you make money. It's one standard deviation out. You have a 69% chance of being right. You're collecting 43 cents. Okay? And what's your risk? You capped your risk. Okay? You capped your risk. Why? Because you're buying the 188 put, which is a little bit lower than here, and you're buying the 215 call, which is a little bit above here. Okay? Now, here's your max loss. So the most money you can make is $43. The most you can lose is $457. You're risking roughly 10 to make 1, but your odds of success is so much greater. Now, what if you want to risk more? Okay, now this is where the golden gecko begins. A golden gecko, okay, is one of my favorite trades, and it's something I've coined, and everyone's been doing very well with it. All a golden gecko is doing an Iron Condor like this, but you're gonna move these two buy positions out to the 2 standard deviation line. Okay, why? Because this is basically like a synthetic or a fake strangle. It allows you to collect a lot more money, but still capping what you can lose. Okay, and it also preserves your buying power, your buying capital. And the trading platforms like Thinkorswim or whatever, they defined pretty much when you buy something 2 standard deviations out of the money, or if you sell something 2 standard deviations out of the money, this is pretty much where how they define risk. Here's what I mean. Because if you sell, and I think you can change this by going to choose strategy. I'm going to change this to like 10 or at least 8 and go and I'll watch what happens. Very good. Okay. So anyway, all I want to do is I want to move this out to about the 2 standard deviation lines. See right here, 2 standard deviation, this blue dotted line. 2 standard deviation, this blue dotted line. Okay. I want the buying strikes, the buying put and the buy call to be further out. And I want the ones I sell to be at the 1 standard deviation line. Okay, so if you want to know why, here, click on this button right here, leg, and it'll show your percentages. You want your short strikes or your selling strikes to be around 84% because that's about 1 standard deviation out of the money. Okay, I'll try to move this. I can't. When it does that, that means there's no strike in between. Okay, so I'm just going to make it as close to 84 as I can. So look. This position has an 85% chance of being right. This is an 82% chance of being right because it, you know. Okay, so combined, I have a 71% chance of the S&P 500 finishing between these 2 strikes at the end of 46 days. All right. So the reason why, oh, and I look at my buy side. It only has a 2% chance of being right. Okay. But I'm not looking to be right here. This is just more like insurance or to cover my butt, so to speak. Why? Because look, now my max loss is $911. The most I can make is $89, but I'm capping my max loss, and I'm getting a nice pop, probability of profit. Okay. Now watch this. I'm going to take away these and look at the. I'm going to remove these, and I'm going to show you what happens over here. Okay. So watch. I'll double click. And I'll delete it. I'll click on this, double click it, and delete it. So they're gone, right? But I kept these the same. Look at what happens to my max loss. It's unlimited now. Okay? If I put them back on, and the easiest way to do that is just to do this and choose Iron Condor again and hit like this. Perfect. And then move it back out or whatever it was. I forgot what I did. You move them out. Look. See, big difference. But this right here, ladies and gentlemen, is a golden gecko. If all you did was do these when IB rank was 35% on a ETF or 50% or higher on a stock, your chances of winning go up to over 84%. Okay, and that's holding to expiration and not managing your winners. But I'll cover that in my next video. Okay, so I'm gonna make this. I have 2 minutes to do 1 minute to do a real quick recap. Okay, so let's do it. On SPY, here's the first thing I covered. Selling a naked put. Okay, bullish bet. You're betting that the stock will be above this price. Anything is green, you make money. Okay, that's a bet. You're bullish, meaning you're betting that the stock will go up. Okay, opposite of that would be selling a call. Okay, go to option, go to sell a call. That's a bearish bet. You're betting that the stock will go down. So here is the stock. Here's where you're betting. It'll be below this. Green is where you make money. Red is where you move money. That's called selling a naked call. So we just covered selling a naked put and selling a naked call. Then we covered doing both at the same time. That's a strangle. Click on strangle, short strangle. Selling a strangle means you're selling both a naked put and a naked call, which means you make money no matter what. Well, not no matter what. Even if it goes up a little or down a little, as long as it stays in this range, you make money. All right? And then we covered the golden gecko, or covering your butt as far as defined risk. That was an Iron Condor. Okay, so go to our Iron Condor, normal Iron Condor, boom. Okay, so again, same strikes. You're still making money here, but you're capping your losses on either end. Okay, a golden gecko just means, and I call it a golden gecko because from Hawaii, where I'm from, geckos are lucky. What you want to do is all a golden gecko is selling a put, and call 1 standard deviation out of the money, and buying the further out 2 standard deviations out of the money. All right, hope that helps. Thanks a lot, guys. Bye.